The current tax rates, particularly in the context of ongoing trade tensions between the U.S. and major partners like China, have notable and multifaceted impacts on the U.S. stock market. Pressure on corporate profit margins. High import tariffs increase the cost of raw materials for many industries, particularly manufacturing, technology, and consumer goods. Companies with global supply chains like Apple, Tesla, and many industrial manufacturers face higher costs, which leads to reduced profit margins and negatively affects stock prices. Erosion of investor confidence. The imposition of reciprocal tariffs creates uncertainty in the market. Investors tend to sell off stocks when they fear that escalating trade conflicts may lead to slower economic growth or even a recession. This heightened uncertainty reduces market stability and investor sentiment, leading to volatility. Sector-specific impacts. Technology. The tech industry is particularly affected due to its reliance on components and manufacturing in Asia. Tariffs can increase costs for companies like Apple, which may ultimately pass these costs on to consumers, hurting demand for products. Industrial and agricultural sectors. Export restrictions and retaliatory tariffs reduce demand for U.S. goods abroad, particularly in agriculture and manufacturing. This decreases sales and earnings for companies in these sectors, further weighing down stock prices. Domestic production or defense sectors. On the other hand, sectors like defense and domestic manufacturing may benefit from policies favoring local production or defense spending, which could provide a counterbalance to some of the negative effects of tariffs. Increased inflation concerns. Higher tariffs raise the prices of imported goods, contributing to rising inflation. This puts additional pressure on the Federal Reserve to maintain high interest rates, which in turn impacts the stock market, especially growth stocks that are sensitive to interest rate hikes. High interest rates make borrowing more expensive, which can reduce consumer spending and corporate investment. In conclusion, the current tax rates are creating an unstable environment for the U.S. stock market. They put pressure on corporate profit margins, increase economic risks, and erode investor confidence. The effects are particularly evident in industries with high reliance on global trade, and they contribute to rising inflation, which forces the Federal Reserve to act further, weighing on the stock market.